Hello everyone, it is I, your desert-dwelling British man. This is Crypto News Daily, where we do the news 5 days a week. And yeah, we're going to have a very interesting talk today, because there's some interesting articles out there. As you guys know, on Crypto News Daily, we don't really cover the same types of news as other crypto channels. I like to pick out different interesting pieces of news, and hopefully you guys like it. If you do, don't forget to hit that like button, don't forget to subscribe and hit the notification bell as well. That really helps me out. And if you really want to help me out, then you can always donate to me down below. I need the money, help. Okay, so as I predicted yesterday, we're going to be going sideways, and I think that this that you see in front of you should tell you that that is what's happening. We're going sideways. BTC dominance is at 52%, which is to be expected, to be fair. The market sentiment is not fantastic, but it's not terrible either. And moving on to the very important news story that I have for you today. How to tell whether a crypto exchange is lying to you. They're all lying to us, and that's not necessarily a bad thing. So shout out to Crypto News. Really so this is a good article, and the reason I think it's a good article is because it will teach you how you can spot whether there is wash trading going on. So a new research report from investment firm CoVenture, backed by Japanese financial giant SBI Holdings, has identified two strategies anyone can use to expose exchanges that engage in wash trading or inflating trading volumes by simultaneously buying and selling crypto assets. One of the most important considerations when choosing an exchange to trade on is volume. Wash trading is when a trader places a buy and a sell order at an identical price without changing ownership of the underlying asset. They use bots to automate these orders, leading to an artificially increased volume. This gives unsuspecting traders the illusion of liquidity, CoVenture explained. According to the report, the exchange is typically following a predictable pattern to make their trading volume appear bigger than it is. Okay, so wash trading usually follows these patterns. Number one, you place an order on a market where the bid-ask Place an order on a market where the bid-ask spread is very high. Then they execute buy and sell orders at a price existing order book does not have. Okay, so they execute the buy and sells, and on the order book that there's no price for that. Okay. Repeat this process until unsuspecting traders place an order close to the bid or ask spread. So you see them place the order, and then you, as an unsuspecting innocent trader, you think, oh, that's the way the market's going, and so you place an order yourself very close to that, and then the person withdraws their order. You see, it's very smart. Person or bot, actually, it's mostly a bot. Top 5 indicators of suspected wash trading. An extremely high percentage of API-driven trades on the exchange. So as I said, bots. A high amount of transactions occurring during hours traders in a specific time zones that are offline. So for example, I'll use the UK, right? I'm not in the UK anymore, but let's use the UK. Most people are going to be probably sleeping about 3 a.m. And so then if you're seeing an exchange that's placing orders around about that time, and it is specific to that area of the world, then you can see that there's some type of wash trading going on. Transactions larger than the order book size. Well, I mean, that kind of speaks for itself. Repeated transactions at same order at an identical price. So obviously there's some type, I mean, I'm sure that we've all seen this, right? You go to place an order, and then someone jumps ahead of you, obviously, but then your order gets filled, or you withdraw it or whatever, and then they keep putting in the same sort of price range. That could be the market, but usually is some type of wash trading, if you ask me. So no price volatility despite high liquidity. That also speaks for itself as well. So to continue on this great article, by the way, which will be linked in the description. Further, the report also explains 2 strategies that can be used by anyone to spot suspicious inorganic trading volume on a crypto exchange. The first strategy is to compare the daily volume traded to the average number of daily website visitors. This ratio can then be studied for several exchanges to understand what a normal ratio would look like. So they have a chart here, and I mean just looking at the chart, look at Bitfarm. Like there's something going on there. I'm not going to say anything. I'm not going to make any accusations. I'm just reading this article. So we cannot be sure as well. And I'm not giving you any type of financial advice. Anyway, Bitfarm has previously denied the report of wash trading. So they're denying it, and they're well within their rights to do so. Another strategy is to analyze the depth of the order book on an exchange. To do this, the report's authors use data from CryptoCompare website to calculate how much capital would be necessary to crash the cryptocurrency price in a top 5 market by 10%. So if you look, there is, I mean, you can crash the price on for example, let's use hit BTC, right, for like 7 mil. It's not a lot. It's not a lot. I mean, I could be misreading that, but either way, the point still remains the same. One crypto exchange that was singled out in the report as having a particularly high inorganic volume was Coinbean, an exchange started in November 2017 that has leapt from being relatively unknown to consistently rank among the top 25 exchanges by reported volume on CoinMarketCap. Now obviously I'm guessing Coinbean are going to deny this, and they're well within their rights to do so. Coinbean reports similar 24-hour trading volume as the well-known crypto exchange Bitconnect, but it takes only 13,600 USD to crash the cryptocurrency price of the top 5 markets by 10%. Wow. To do the same on Bitfinex would require 9.47 million in trading capital. To explain why exchanges engage in wash trading, the report illustrated the problem exchanges are facing as a classic chicken or egg problem. In order to achieve high volume, investors need to trade. Yet, investors tend to gravitate towards exchanges with high volume because obviously they begin to trust those exchanges. They see a lot of people are going there. So people are like sheep in general, and I don't mean that offensively, but they are. They go to places where they know that their money will obviously be secure, right? Which makes sense. As previously reported by CryptoNews.com, the practice of faking trading volume on an exchange through wash trading is very much alive. Most recently, a report from the Blockchain Transparency Institute claimed that wash trading makes up over 80% of CoinMarketCap's top 25 Bitcoin pairs by volume, and thus the market as well. Which, to be perfectly honest with you, I'm not totally against wash trading. I know, like, don't attack me, but the reason that I'm not is because of that chicken and egg scenario, and I want there to be a lot more exchanges, right? Like, I want us to have diversification of exchanges that we can choose from, and some of them to become visible, they need to do this. That's the truth. That really is the truth. And so, talking about wash trading, Bitcoin has surpassed PayPal in yearly transaction volume at 1.3 trillion. Now, if you ask me, unless PayPal adopts some type of cryptocurrency, which if they were smart, they would, then eventually they're not going to be around. That's, I mean, they'll probably get absorbed maybe into a bank or something, but yeah, I don't think PayPal are going to last, truthfully. I mean, it'll be many years before they disappear though. Anyway, for the second time since its inception, Bitcoin surpassed online payment giant PayPal in annual transactional volume. Per the data collected from global statistics portals, The Bitcoin network posted $1.3 trillion worth of transactional volume in 2018. Within the same time frame, PayPal recorded 578.65 billion worth of payment transactions. It was the second time in a row that Bitcoin outran PayPal in 2017. The digital currency network had posted 543.52 billion more transactional volume than the global firm. But remember, there is wash trading going on. I mean, this is a very interesting graph here, and I'll leave a link in the description down below so you guys can go check it out. Regardless of the stark difference between their performances, both Bitcoin and PayPal benefited from an increase in remittance. I mean, obviously Bitcoin, the remittance increases are obviously to be expected, because that's what we want as a community, right? We want people buying goods and services and so on. So we're really pushing for that. So that's really good to see. The World Bank reported that overall cross-border transactions grew 10% to $689 billion in 2018. Large diaspora and overseas expat population contributed hugely to the uptrend, leading to a higher usage of services like PayPal and Bitcoin. Nevertheless, Bitcoin did not only serve people looking for cheaper cross-border transactions. The digital currency saw a majority of its transaction volume coming from traders. Again, there was some wash trading going on, so maybe there's not as many traders as we think. According to the report, the crypto sector as a whole posted record transaction volumes, cross-leading crypto exchanges in 2018, with Bitcoin leading the pack as the most dominant asset. I mean, that's obvious obviously Bitcoin is going to be the most dominant asset. It is unclear how many users utilize Bitcoin for remittance, especially when traders were using the same asset for speculation. It explains how Bitcoin managed to surpass PayPal in terms of transaction volume. The latter merely focused on payment and remittance services, while the former remained a multifaceted asset, which obviously Bitcoin is. The World Bank estimated the remittance market to grow 3.7% to $715 billion in 2019. The prediction signaled that services like PayPal would continue to record higher transactional volume in the upcoming fiscal quarters. As for Bitcoin, the digital asset expects to attract significant institutional investment with the launch of regulated Bitcoin derivative platforms like Backed. Guys, everybody is looking at Backed to save Bitcoin, right? Or to increase Bitcoin's price. And I'm going to be called crazy for this, but I don't think Backed is the savior that we hope for. I really don't. I don't think Bitcoin needs a savior. On top of that, Bitcoin could also attract more adoption if the Securities and Exchange Commission approves the first Bitcoin-based exchange-traded fund this Q2. They're not going to. ETFs, it's too volatile. We're too volatile, and we don't need ETFs. I'm in that camp, guys. I'm in the camp of, like, we don't need banks. We don't need that. In fact, by bringing them in, you are doing a deal with the devil, really. So as a community, I think personally they're already in. Okay, like governments and banks and so on are already in. So we shouldn't care that much. We should care that they're coming in as in a bad way, but we shouldn't care that the positivity that they bring to the space. Anyway, interestingly, the more Bitcoin becomes an investable asset, the lesser it would attract the remittance users. That's not necessarily true. It is plainly due to the Bitcoin's underlying price volatility. Users would be less inclined to utilize money whose value could change drastically within minutes. Bringing in institutional investors, do you really think that we're going to have crazy volatile price spikes and dumps? It's not going to happen. Like they will deliberately try to make this market boring Despite the Bitcoin's cheaper transaction fee structure, remittance would most likely choose a PayPal or a TransferWise because they would ensure stability. Stability is coming to Bitcoin. You bring institutional investors in, and that's what they bring. Nevertheless, in other parts of the crypto sector, projects are attempting to solve the volatility problem. At the same time, they are retaining the cheaper transaction status attached to cryptocurrencies. Social media giant Facebook, for instance, announced that it would launch a stablecoin for remittance. That's not a surprise. If Facebook launches a stablecoin they are reportedly building, it will quickly become the most used product in crypto, said Anthony Pompliano, founder and partner at Morgan Creek Digital Assets. If Facebook launches the stablecoin they're reportedly building, he said, WhatsApp has over 200,000 users in India alone. The Indian government has been fighting crypto too, so things are about to get very, very interesting. Just recently, banking giants JPMorgan and Mizuho launched their own stablecoins for the purpose of cheaper cross-border intrabank transfers and payments. See, banks are already in the sector, and I'm not a massive fan of it, but it seems like it's inevitable. And so, talking about banks, Swiss banking giant Julius Baer to offer its clients crypto asset services. Now, we saw recently this week that there are other banks that are talking about being the bank of the future that are also doing the same thing. So the banks are falling into line and getting into crypto because crypto is an existential threat to their existence. And we all know what happens when an existential threat arises against banks. They try to buy it, and that's what they're doing here. Swiss bank Julius Baer plans to provide its client access to digital asset services following a partnership with crypto bank startup Sebo Crypto. Now, if you look at Sebo Crypto, which we will do here, just looking at it, finance redefined for the new economy. Sebo is a pioneer in the banking industry with a mission to build a FINMA supervised and progressive technological bridge, yada yada yada. Basically, they're going to be a connection for the banks to get into crypto. That's what it is. So the partnership will come into effect when SEBA is granted a securities dealer and banking license by the Swiss Financial Market Supervisory Authority, the press release notes. The Swiss bank will then begin offering digital asset storage, transaction and investment solutions in partnership with the crypto startup. The announcement also discloses that the banking giant has been a minority shareholder of SEBA since last year. So they bought in last year. Think about that. When everything was going on, the banks looked at the bull market and they were like, yeah, this is a threat. And then all of a sudden we're in a bear market? According to the press release from SEBA, the election of Peter Gerlach, head markets at Julius Baer Bank, to SEBA's board of directors will be proposed to the company's shareholders on March 20th. Gerlach was quoted in the announcement as saying, at Julius Baer, we are convinced that digital assets will become a legitimate, sustainable asset class of an investor's portfolio. Not will become, they already are. Seba Crypto, which aims to become a bank offering cryptocurrency-related services, raised 100 million Swiss francs, about $99.8 million at press time, for this purpose at the end of September last year. Julius Baer reported having in 2018, Julius Baer reported having 382.1 billion Swiss francs, about 381.6 billion in assets under management. As Cointelegraph reported at the beginning of this month, Seba Crypto signed an agreement with Swiss mortgage bank I'm not going to be able to say this. Hypothekar Bank Lenzburg AG to use its core banking system, Finstar. Also in February, news broke that Switzerland's principal stock exchange, SIX Swiss Exchange, will test blockchain integration for its forthcoming parallel digital trading platform, SDX, in the second half of this year. So banks are in. They got in last year. This proves it, and it's only a matter of time before the crypto market is not as destabilized as it is now. Some people will view that as a good thing, others a bad thing. I'm in the bad camp on that. But I don't blame you if you're looking for some type of stability. I got no hate in my heart for you for that. I mean, obviously banks rule the world, and if they can't rule the world, then they'll buy the thing that rules the world. Now, if you agree with that, guys, don't forget to hit that like button. Don't forget to subscribe. Don't forget to turn on the notification bell. And if you want to support this channel, there'll be links in the description down below where you can do that. And yeah, it's getting interesting now, guys. It's getting really, really interesting. Have a great day. I'll see you tomorrow.